Okay, great. So tough act to follow from the first panel, but we're going to do our level best to do that. So before we dive into the present panel that aims to focus more squarely on bank and financial regulation, I want to briefly introduce our three panelists. We're lucky to have three distinguished panelists with a wide range of deep and valuable expertise that will make for a rich and engaging discussion today. So Andrew Olmem, to my immediate left here, is a partner in Mayor Brown's DC office and a member of the Public Policy, Regulatory, and Political Law and Financial Services, Regulatory, and Enforcement Practices. Prior to joining Mayor Brown, Andrew served as the Deputy Assistant to the President for Economic Policy and Deputy Director of the U.S. National Economic Council, where he oversaw the development and coordination of domestic economic policies. Andrew's work was focused on financial services as well as other important economic sectors. In particular, he led the administration's successful efforts to pass the Economic Growth, Regulatory Reform, and Consumer Protection Act, or AGRIPA, as most of us know it. In addition, Andrew served as Republican Chief Counsel and Deputy Staff Director for the U.S. Senate Banking Committee, where he played a significant role in the deliberations of the Dodd-Frank Act. And before law school, Andrew served as an assistant economist at the Richmond Fed. So further down to my left is Dick Berner. So Dick Berner is a clinical professor of management practice at the Stern School at NYU and also co-director of the Stern Volatility and Risk Institute. Prior to joining NYU, Dick was the first director of the Office of Financial Research. And prior to his service at the OFR, Dick held an array of senior positions, notably serving in chief and senior economist roles at several large financial firms. Finally, Dick served on the staff at the Federal Reserve Board for a number of years, and I would be remiss not to plug my alma mater and point out that Dick earned his PhD in economics at Penn. So further down, last but certainly not least, is Marc Saidenberg. So Marc is a principal in the EY Financial Services Consulting practice and is the co-lead of the Global Regulatory Network. Marc has worked with clients globally to enhance capital and risk management, resilience, and governance. Marc has over 20 years of banking experience, including more than 15 years with the New York Fed, where he was a senior vice president and director of supervisory policy. While at the Fed, he was a member of the committee that oversaw the supervision of U.S. GSIBs. In addition, he represented the New York Fed on the Basel Committee during the development of Basel III capital and liquidity standards. Marc also has valuable and important experience working at a large investment bank and earned his economics PhD in comparatively sunny Berkeley, California. So before we dive in, I want to talk a little bit about our first panel. I want to talk a little bit about where we are relative to our first panel. So our first panel took a broad frame view of the economy and the large bank sector. In this panel, we're going to turn up the microscope just a bit and focus a bit more squarely on large bank and financial system regulation. More specifically, given the events of the past few years, what are the key challenges that need to be tackled with regard to large bank regulation and financial system regulation more broadly? What do the events of the past few years tell us about those challenges? I want to turn to our panelists to hear their views on where we are headed. But before doing that, I want to say just a few words about where we find ourselves. After all, it's often hard to tell where you're going if you don't know where you are. Between the first quarters of 2020 and 2022, we have seen foreign member capital increase by over $60 billion and liquidity levels increase by over $600 billion, which speaks to the multi-decade highs of capital and liquidity as recognized by the Federal Reserve's Chair Powell. In addition, foreign members have continued to serve the economy by growing their deposit base by over 25% over this period, a point that Don Code made a few minutes ago. At the very same time, when we look at capital requirements for foreign members, we see increasing stringency, whether that be in the form of higher stress capital buffers or higher GSIB surcharges that are expected to take effect in early 2023, or increasingly more binding leverage requirements. Finally, if we take a broader view of banks, we continue to see their footprint in the financial system shrink. According to the Fed's flow of funds data, over the same period, banks' share of total financial system assets declined by 3.5 percentage points, furthering a decades-long trend. So now I want to turn to each of my three panelists, starting, of course, with Andrew and moving down the line. So against that backdrop, and given where we are in the large bank regulatory cycle, what do each of you see as a significant issue and risk in the regulatory arena that will need to be considered in the near term? And Andrew, again, we'll start with you.
Sean, first, thanks you to the forum for having me here today. Well, I think you have to first start with two big kind of macro risks before we move into the more traditional prudential and financial stability risks, which are clearly the outlook on inflation and geopolitical risks, particularly around Russia. Both of those events right now are driving the regulatory agenda more so than anything else. And to give an example, the rise in inflation not only is requiring the Fed to raise rates at its fastest clip in a generation. I think we're going to see a fair amount more of that. But it's also impacting public policy. We see most recently with the efforts on the Pass the Build Back Better bill. Senator Manchin has been very clear that his vote depends on an improved inflation outlook before he would move on a larger package. The recent 9.1% inflation number has clearly caused him to hold back from moving forward on that legislation. With regard to Russia, that's certainly not only impacting larger institutions because of all the new sanctions regulations that have been rolled out. AML compliance is up. So I think, as always, we tend to look. Every new administration comes out and has some ideas on where they want to go. We all who are active in bank regulatory policy always have a few issues that we're hoping to get tackled at some time. But it really is the day-to-day events that do often drive the most important policy actions and the ones to watch most closely. And I would put those two at the top of the list. But then moving into the more traditional areas, I would say that we are now at a really interesting inflection point because just last week, Michael Barr was confirmed to be the new vice chair for supervision at the Fed. And so due to our funny system, the administration just now, year and a half in, finally has its financial regulatory team in place. So now we're at the point where we're actually going to find out what they want to do. The administration has issued some executive orders that have been given some ideas and frameworks around bank regulation, digital assets, of kind of where they conceptually want to go and priorities. But the real details, as we know, really matter here. And now that they've got their team in place, I think we've got a chance to see where we're going to go. So I think we just have an uncertainty right now around bank regulation in general about where we're going to go. A couple areas I would just highlight to watch for is, we have the finalization of Basel III, which has been expected for the end of the year. But a new vice chair very well could come in and say, I'm here and I have every right to put my stamp on the finalization. So I kind of look forward to hearing where just general Vice Chair Barr is going to be on capital and liquidity regulation. I'd also say bank M&A is the other big risk. That has been one area where the administration has been very clear in other contexts that they want to have a more stringent antitrust regime. You've seen Lena Khan at the FTC, who's basically wants to overturn the kind of Borkian revolution in antitrust and move away from consumer welfare as the standard for evaluating mergers. We've seen Rohit Chopra, who is on the FDIC board, issue similar statements. So I think M&A risk is real, and we can talk more about that. And then I'd say climate change policy is the other large policy that we're going to see more out of the regulators on. We've already seen it out of the SEC. Again, that's a big area that we can come back and talk a little bit more about. But now, where's the Fed going to go? Now that Barr is in, that has been climate change policy and ESG in general has been a huge focus of his confirmation and the prior nominations before him. So he has definitely a very careful path to walk along that to move policy in that area.
Okay, great. Thanks, Andrew. Dick, on to you, please.
Thanks. And thanks to the forum and to you, Sean, for having me here today. So my framing is a little bit different from Andrew's and harks back to a lot of the things that were discussed in the first panel, because I tend to think about where are the financial system vulnerabilities that need most urgent attention, be they in banks or elsewhere in the financial system. And I think the most important, as the previous panel discussed, particularly Don, are in non-bank finance and in critical or what may be called systemically relevant markets, including runnable liabilities, leverage, maturity, and liquidity mismatches, which can create run and fire sale vulnerabilities. So I think the biggest and most glaring failure of the post-financial crisis regulatory reform program is that we really don't have a framework for the regulation of non-bank financial intermediaries that are providing financial services, including to some extent banking services. And what I say is that part of that framework might involve what Augustine Carstens referred to as same risk, same regulation, or same outcome. In other words, we should look to where the risks are in our financial system, and we should think about what's succeeded and maybe what hasn't in terms of regulation, and try to use those principles and translate them into specific recommendations. And we're going to talk a lot about, as this conversation goes on, about some of those specifics. But I think it's fair to say that that's a key element that ought to be incorporated into the framework. And I think the advent of crypto assets and decentralized finance adds a lot of urgency to completing this task of developing and implementing a framework. And another principle is that it ought to be based not just on entities, as our legal construct requires, but it also ought to be based on activities. I think we need to move away from who you are to what you do. Both are needed, but I think marrying those two things is the big global strategic issue for financial authorities today. If we don't solve that problem, I don't think it matters a lot what else we do. They may have significant implications, but that's really the big challenge. And maybe I'll leave for later some of those specific recommendations, but we can come back to that.
That's great. Thank you very much, Dick. Marc.
Thanks, Sean, and thank you, and thank the forum for inviting me to participate in the summit. To start, I would say, first, I get really far in life if I say I agree with Don. It usually gets me through most conversations, so I'll put that out there at the beginning. The second is to offer a quote from one of my favorite poets, which is, "It's not black and white, that's only through a madman's eyes." I choose to think we're not all madmen or women in the room, and so our discussions, I think, usefully come up with some framing, and to be partly reflecting, as Sean described, my background, I actually have a framing, I think, that we could use, that we all use in some ways, that really goes back to, in fact, some of the things we were thinking about in 2008, 2009, as we were really working on Basel III. It's like, first, are we clear on our objectives? Second, do we understand the consequences of pursuing the regulatory change, regulatory reform, both in terms of intended consequences and therefore being able to understand what were the unintended consequences? Became one of the jokes among some people at the Fed that some people would complain about an outcome, and then you have to stop and say, well, that was an intended consequence, not an unintended one. Third, and Don teed this up, really an appreciation of understanding costs and benefits, and particularly from the social perspective or public perspective, which in addition to the weaponizing point that Don made, translating anything into an appreciation of its public impact and not just the private cost benefits is incredibly difficult, because it's much easier to measure the direct private cost against the somewhat difficult to measure, difficult to point to, uncertain in time, uncertain in realization, potential public benefit. Fourth, useful to also remind ourselves the limitations of regulation. The simple version of that is, we all know the sort of pushing on a string analogy. Regulation can either establish or take away a set of constraints. You can't actually, which has the effect of influencing institutional and individuals' behaviors. You can't change behavior if it's not a constraint or by establishing a constraint. So I think there's a discussion about, in an environment where individuals, firms, the market is de-risking, what exactly can regulation achieve at those times? Against those four sort of framing, I do have three questions that I think it's useful to ask ourselves, which point to some of the things I think that should be on the table right now. First, are we effective in achieving the goals that we've established? With an appreciation that some of those goals may not be fully consistent. Questions of firm liquidity, institutional liquidity, and questions of market liquidity are not always coherent in how best to achieve them. Second, are we efficiently achieving those goals? And to be clear, I mean efficiently achieving the public policy goal, not just is it efficient from an individual firm's perspective. I think, and this is a phrase that came up probably frequently in the last 10 years, are we doing so as simply as possible? I think a useful modifier is as simply as possible, but no simpler. And then finally, one that became really a New York Fed mantra, is it robust to uncertainty? Because going back to my quote, if any of us think we know exactly what's going on at any time, either for firms, markets, or what will happen in the future, we're kidding ourselves. So I thought Yelena's comment was very important. And it's not just a question of, are we always fighting the last fire? The next crisis is not going to look the same. But are the work we've done through the regulations of, some sense, responding to what we know, responding to a recent crisis, do they put us all in a better position? So having said all that, I agree with many of the comments, if not all the comments in the first panel. The financial services industry, and particularly the large institutions, were certainly not a source of instability. I can debate, and be positive. A source of stability because it went into the crisis, and there were no questions of forced de-risking, questions of runs on institutions. And so as we think about how to efficiently achieve goals going forward, and maybe looking to be simpler, I would say, can we achieve that without losing that benefit? So a few topics, some of which we will put on the table today, some of which have been teed up. I think there's a real question about what's the interplay between the regulation of the largest banks and the regulation or not of some of the non-bank activity. There's an interesting trade-off between non-bank activity being a safety valve, if you will, from regulation, and non-bank activity being a dislocation that introduces systemic risk. Other ones that are in that same family, but now within the banking space, I think some really good discussions about what role the both the leverage and supplementary leverage ratio play. You could also say that I would also say the same thing about the net stable funding ratio. Didn't play out, but two things that were introduced explicitly as backstops. Good discussion about what is the role of a backstop. And then one that doesn't, two others that don't get as much play. Useful discussion about where we are in resolution planning. I know generally we've declared victory. I like declarations of victory. The question is, did we declare victory over the right thing? And then finally, I think there's a question which doesn't come up as much, which is really around the definition of capital, and one that I would say is, in which I would also include TLAC, just to be fair, where the real question is, with 13 years of experience and one financial crisis, I will borrow a quote from one of my favorite people on the planet. If you have to ask if it's capital, it's not. And so why we have a regime that incorporates many things that are essentially expensive forms of funding so that we can call them capital is a mystery to me. So, Sean.
Okay, thanks, Marc. So there's a lot in there amongst all three of our panelists. We're going to try and get to all of it in the time that we have available this morning. But let me just kick things off, maybe starting down the line again. Andrew, I'll ask you to respond first, and we'd really like to get the thoughts of Marc and Dick as well. So, if we think about what's gone on in the regulatory space over the last couple of years, it seems like for a variety of reasons, the extensive margin of regulation is marching outwards. So whether we think about crypto assets or we think about the climate change issue, it's clear that, again, that the sort of the periphery of bank regulation potentially seems to be increasing over time with respect to new issues and new risks. And as an event that occurred recently, there was a legal case involving the EPA and how that relates to another regulator here in DC, and that brings to mind certain sort of specific questions around the legality of what's okay and what's not okay from a regulatory perspective. And Andrew, I'd love to get your thoughts as a legal expert on what implications, if any, do you think that recent decision holds with respect to extending the extensive margin of regulation in the prudential sphere, and basically how do you see that?
Yeah, I think the case you're referring to, the West Virginia v. EPA, which just came down at the end of the term this year. And I'll skip kind of a background on the details, but basically the court came out and said that there are extraordinary cases when an agency seeks to interpret its authorities and says it has a certain authority that has political and economic significance, but is not supported by the history and breadth of the authority that's asserted, where the court is going to insist that Congress provide clear authorization for that authority. So in many ways, this actually builds on, for those of you who kind of went to law school, like I think of the steel seizure case, where actually the politics were a little bit reversed, where you had kind of the New Deal court actually came in and said Harry Truman couldn't nationalize the steel industry without clear congressional authorization. So that's kind of the framework, I think, to think about it. Now, Chief Justice Roberts, who wrote the decision, was very clear that this is for extraordinary cases. So this is not something I expect that courts be using all the time. That said, there are a couple of rules out there that right now I think fall squarely within this. And the one I would tee up first would be the SEC's climate disclosure rules, where the SEC is using 1930s authorizing legislation to impose new disclosure requirements related to climate, and is not requiring a materiality threshold. There are kind of no limits then under that threshold on what the agency then theoretically would be able to require disclosure under. If you pair that up with the court's factors in West Virginia and the EPA, you can see there's an issue there. I think the SEC's private fund rule actually probably falls into this. Interestingly enough, though, the Fed has actually taken a different approach on its climate work, and it has been very careful so far. If you go back and look both with Vice Chair Brannard's and Chair Powell's statements on this, is that they are looking through climate solely through a safety and soundness lens and a financial stability lens. And those are clear authorities for the Fed to act. They're not saying we're taking regulatory actions to address climate change. They're saying we're taking actions to address safety and soundness and financial stability. The safety and soundness prong, very strong historical basis for that. Financial stability, not as strong, but it's still, because the Fed technically doesn't have a mandate, direct congressional mandate for financial stability. And in fact, Congress actually rejected it during the Dodd-Frank piece. We can get into that, but there's still enough tangential authority, the history of the Fed, and with the FSOC, where you can see that is very different than what happened in the EPA case. That said, this will be an area where the regulators will have to be very careful in how they move forward. And if you start to see things, the regulators saying, we're going to start putting in quantitative limits on who you can lend to, you actually could run into some problems here under the West Virginia case. One technical note I'll note is that you probably won't see this as a Supreme Court case always, but it's more of an issue for the circuits. And the circuits very well could use this as a way to uphold some of these regulations if they perceive to go too far. And one of the interesting things with the dynamic with the court now is that because the liberal justices only have 3, they don't have the ability to bring cases before the court and force the other justices to rule on them. They can all the 6 conservatives can just let the circuit courts decide these going forward. So I actually see the kind of fights here moving to the circuit courts on this issue.
Dick and/or Marc, if you have any thoughts on just
Sure.
the general issue.
I think there's a common thread here that's really important, and Marc alluded to it at the start, which is how do we think about effectiveness and efficiency and what we're trying to accomplish, and think back to what the objectives are. And so, I have a list of things that I think regulators ought to do. At the top of the list, really, is improving governance and accountability for all regulators, financial stability regulators, safety and soundness regulators in the financial arena. I think that it's pretty clear in some cases what the law defines. In other cases, it's more ambiguous. And I think that the regulators owe it to themselves and to everybody else to make it clear what those objectives are and to be accountable for them. There's been some work done on that, and I think the work shows that it's insufficient. Coming back to some of the specific issues, just to agree with Don's 2 things on the large banks, I think that exempting reserves and maybe treasuries from the SLR is an important thing that we ought to look at going forward. But we ought to make sure that we re-level capital to preserve ratios and the levels of resilience, as did the Bank of England back in 2016. And the second thing is using the countercyclical capital buffer as a way to think more broadly about buffers, because I think that's really important to release capital in times of shocks and to build it up in good times. And that's, I think, a better way to reduce procyclicality. Andrew referred to climate and to other kinds of risks. And there's no question that we face a lot of risks in what we're looking at. I teach a course in risk management that covers climate, cyber, geopolitical, pandemic, as well as financial risks. And there's no shortage of material there. When we think about how the financial regulators, for example, ought to respond to climate-related risks, my view is that they ought to focus on the consequences of climate risks, not necessarily on the causes. And that is in line with their authority, I think, as Andrew mentioned. And it's something that people can get behind and think about. And I think that's broadly true for a lot of the shocks that we're facing that are hard to analyze, hard to measure, but we need to think hard about those for non-bank finance. I think a critical area here, which we've only alluded to, is to think about 2 things related to liquidity on the supply side. One is the one we just mentioned, but there are a couple of other things. One is I think we ought to finally start to think about crafting a haircut regime for repo and securities financing transactions, including perhaps minimum floors. And I know that's hard to do. We've been talking about it for decades, but it's something that I think is finally time to either implement or put to rest. But second, we do have in the United States a standing repo facility. It's been narrowly conceived because it was primarily aimed at monetary policy considerations under the statute. I think it ought to be broadened to include a broader range of counterparties to serve financial stability needs as well as bank or monetary policy operational needs. On my list, I have other things that we can talk about, the last of which I think is, but not often discussed so much, and I think Don alluded to this, is I think we need to improve liquidity, stress testing, resolution authority, and reducing misaligned incentives at central counterparties. I think that is an area that can be a source of both market and financial stability risk, and we haven't paid enough attention to that.
Focusing for a minute on the perimeter question, I think actually Andrew's tee-up creates a interesting tension for banking regulators. I mean, we've come through basically my entire professional career where there was, I don't know if comfort is the right word, but sort of certainly extensive use of indirect regulation of non-bank activities by imposing restrictions on the interact of one form or another, not binary, you may or may not, but capital requirements, other type risk management requirements on restrictions on the interaction between the regulated institutions and the, let's call it broadly non-bank sector. And that's a case where if you wanted to point back to hedge funds and the financial crisis, you'd say actually it kind of worked in the to a degree in that if we go back to 2004 or 5, that was everyone's source of concern, was arguably either because it was a known source of concern or not, it was not the problem that was quite as drastic in 2008 and 9 as many feared. Now, but that I want to bring that up and then say that gets me back to my effective, but is it efficient? And I think that's a case where when we look today, I had some hope, I have hope, I'll say it a positive way. I continue to have hope that Dodd-Frank actually tried to address there's only one, well, let me rephrase. Dodd-Frank addressed that there's only two levers before that where it was either regulate the banks or pass new legislation. And one could argue the whole point of FSOC was to identify the things that sat in the middle. We established an authority to regulate either institutions or activities in some ways for explicitly the cases where it wasn't within the regulated sector already and it may or may not be efficient yet to pursue new regulation. And so when we talk about climate risks, the financial risks of climate, one could also throw digital currency, digital assets in. We are at risk, I would say, of leaning extensively into the indirect regulation. One would say we are already leaning into indirect regulation. And the prospect of second channel legislation, I think, with great respect to many people in the room, let's call that zero or near zero. Never say zero in any setting. Really low. And it really then begs the question, what is the role for FSOC in engaging in a conversation about those risks, whether it's, I would say both climate and digital currencies. And it's a difficult situation where I will be the first to say I was a little surprised that FSOC's primary answer was to say, this requires more legislation. That just believe it. That surprised me.
Okay, thanks. So again, just to kind of push on that theme a little bit and maybe to return to a topic which that was discussed in the previous panel to very good effect, but to pick up on that a little bit, when we think about liquidity broadly defined. So in the events of the last couple of years, I think at different points in time, liquidity came into sharp focus. Treasury markets already been discussed, but of course that was not the only place where liquidity came into focus, especially early on. And it seems like there's, when we think about liquidity, we've got institutional liquidity. So in the context of the banks, initially we sort of have a lot of liquidity at the banks, and we have market liquidity. There were some tremors earlier on in the repo markets that's already been discussed that maybe market liquidity was, not the quality wasn't quite where we needed to be. Then we had the initial stages of the pandemic. I'd really like to get your thoughts, and maybe we can start at the far end of the dais here so that we kind of mix things up a little bit. What are your views on, the relationship between, market liquidity and institutional liquidity, and especially this point about banks and non-banks? I mean, Dick, I'd really like to get your points on this because I think you have a unique perspective to help us think about this where, I think from my perspective, we have a machinery for regulating the financial system the machine's been built for 100 years for basically regulating banks and large banks in particular. And if you want to pull that lever, you can pull it basically relatively quickly. Elsewhere, it's really hard. So to your extent, from your perspective, to what extent is there a lot of good discussion, a lot of productive energy around, hey, we need to do something in other arenas, but at the end of the day, we got this lever to pull, so let's just pull it.
So maybe I'll start, and to your point, Sean, I think something you said is really important, and we talked about this briefly before. I think we have to be very clear when we have a discussion around liquidity if we're talking about institutional liquidity versus asset liquidity. So for those that know that what I did during my summer vacation, so to speak, during the financial crisis, the fact that there was not a run on large financial institutions, one could argue because there wasn't the same set of strains, that institutional liquidity was not a concern. If institutional liquidity had been a concern 2 years ago, I would have been so depressed. It wasn't. Good news. But that does not fully address the question of, there's two questions. One, did we go too far? Reasonable question. Are buffers usable? Very good question, which starts with what do we mean by the question? But on the asset liquidity side, I think we have to look at what is, to two things. What is constraining the asset liquidity? And the other is the pushing on a string problem. So, it was made, even a point was made during the first panel, flight to quality was not limited to the non-bank sector. Flight to quality, or to corporates, flight to quality was a financial institution response as well. And so I think the willingness to provide market liquidity, in 2008, 2009, everyone was very fond of the catch a falling sword analogy. And from what I could tell then, the only thing that catches a falling sword is the floor. And then when you're at the floor, good news, then we'll talk about who picked it up. But I do think it's a good discussion to ask the question, what are the unintended consequences of some regulations that may be impacting asset liquidity? If real or perceived leverage ratio was a constraint on providing market liquidity, then asset liquidity, that's a good thing to investigate. If only we had, we do. We have a natural experiment. Indeed. We have one that actually works because it was reasonably unanticipated. I don't think any of us assumed either the pandemic would happen or that there'd be a relaxation of the SLR. And so I think a good research question, analytical question, is what exactly happened to market liquidity after the relaxation of the SLR? And in particular, what was the relationship between banks providing access to or supporting market liquidity? Now, I will be the first to say there's a little thing like Fed flooding the markets happening at the same time, which may make the identification problem a little hard, but at least there's something there that we did not have at any time before that will help sort of give us a sort of direction of investigation.
I agree with Marc. I think that's a great research question, and it is complicated by the fact that we don't know how resilient markets are in providing what we're calling market liquidity or asset liquidity because the system was so flooded with liquidity. I can remember talking to a Federal Reserve Bank president when we talked about the resilience of CCPs during that particular shock. And I said, so what do you think about the resilience of CCPs in the wake of the pandemic shock? He said, I have no idea because we threw everything but the kitchen sink at the financial system. And so it's hard to tell how resilient are these institutions. I've done a lot of work on that. And my answer is, they could use more resilience, basically, because they are part of a system of intermediating liquidity and transforming counterparty risk into liquidity risk. And so they should be candidates, at least, for some kind of a backstop, appropriately priced with risk in that regard. I think about funding liquidity as opposed to institutional liquidity because it comes from a variety of sources. And look, let's look at the basic supply and demand characteristics. We've had a massive increase in debt, not just here, around the world, and limited supply capability of traditional liquidity providers, broker-dealers, interdealer brokers, and so on. The system is having trouble coping with that, and regulation plays a role, but not the only role in doing that. So we have to think about, in an era where debt is large, maybe stabilizing, maybe even shrinking as far as some balance sheets are concerned, what that's going to look like, I think, as the Fed rolls, for example, Treasuries and MBS off its balance sheet, what's the liquidity in those markets going to look like as that happens? And I think the Fed is being, careful to telegraph what they're going to be doing because they're very aware of the potential for shocks to hit those markets, which they want to try to avoid in a period when they're not all that resilient. So I think that we need to investigate further, both on the supply and demand sides of liquidity. What are the sources and uses? What are the impediments to providing liquidity relative to the past? Maybe the system really functioned well in the past and we weren't quite aware of some of the problems that were there in the past. And that's why I think we need to think broadly about those questions. And some of the things that I would recommend, in addition to what I mentioned, we haven't talked about central clearing of treasuries. That may be a way to alleviate some of the balance sheet pressure, both treasuries and repo. But again, while my good friend Darrell Duffy thinks that that's a central remedy that we ought to pursue, I think that that's only one of several remedies that we ought to be pursuing in this regard. And when we think about liquidity, we need to think about some of the rest of our financial system. After all, we have money market mutual funds. We have open-ended mutual funds, all of which were bailed out, if you will, with facilities that were set up in the midst of the pandemic shock so that they would have access to liquidity. Is that the way we want to run the system? Probably not. Are the two liquidity ratios we have for banks really operational? Marc, you talked about, are these things effective and are they achieving their goals? Not even clear to me what the goal of the NSFR, the net stable funding ratio, is in light of the fact that we've got the liquidity coverage ratio. Are these things redundant and duplicative? I have reason to believe that in fact that they are. Where's the binding constraint here? Is there a binding constraint? And how do we free up those markets? So I think there's a lot of work to do across the financial system in understanding these issues.
Well, I agree with both my co-panelists' remarks. Maybe the thing I would note here that I've experienced in my time is that I think the United States is pretty good about crisis response. Despite all the, it's very popular now to be very skeptical of our political system and particularly Congress. But my experience, having worked in both branches during both crises, that in a crisis, this country does come together and does respond pretty darn well, particularly when you compare it to the rest of the world. Where I think where our weakness is that we don't do a very good job after the crisis in building national consensus around, okay, this is what happened, and this is where we need to build a national consensus about how we can improve our system. And the classic example of this is we set up a commission after the 2008, the Great Recession, to examine what went wrong, and they passed Dodd-Frank before the commission ever issued its report. It was like we got it exactly backwards, so it was totally useless. So I think that's why I think these forums are very good, but I think we need more of these because there's a lot of good research out there. The United States does a phenomenal job of generating research, but we don't do a good enough job about building that national dialogue so that we can get particularly Congress to do its work, because I do actually think Congress does move when it needs to, and that a lot of these issues are better addressed with clear statutory guidelines rather than kind of the ad hoc FSOC approach. As you've seen, you get less court battles. Regulators, it's also, I always feel somewhat unfair in crises to turn to regulators and say, hey, listen, we need you to do X, Y, and Z. And they say, well, where's the authority to do that? And it puts them in an unfair position. And it also addresses issues ahead of time. One can think of digital assets right now is a good area for us to do this on. I keep thinking of how many times we've dealt with money market mutual funds, and I keep thinking, well, if we'd done this 30 years ago when they were a much smaller part of the economy, and it would have been much easier to get a regulatory regime that was stable. So it's like moving early can have a lot of big benefits to regulation down the road.
Okay, and I think to Andrew's point, let's remember that under the statute, FSOC only has two binding authorities, right? and they include basically designating institutions, certain kinds of institutions, whether they're DFMUs or large complex financial institutions, for heightened prudential supervision. That's it. The rest is just, name and shame, show and tell. Let's make sure that we give instructions, but those instructions don't have to be followed because there isn't a statutory authority to do that. So I think that's important. And to Marc's point, Marc said, sometimes the indirect regulation can be a safety valve. I would say it can also be, the source of regulatory arbitrage. Mm-hmm. Because if we're regulating one part of the financial system and not the others, then activity will tend to gravitate away from the regulated, and you made that point, Sean, away from the regulated part of the financial system and towards other parts of it that are less transparent, more opaque, less well regulated, less well understood. So I'd certainly endorse what Andrew said. We need to think hard about, statutory authority that's simple, but not too simple, that gets us in the right direction.
Just before we go to the next question,
please.
Just to be clear, Dick, the safety valve is exactly what I was thinking of as a safety valve is exactly that arbitrage, excuse me. I'm not, in principle, that's not a bad thing. I think we've at times all looked at it and say, well, where we have undue pressure from regulation, there should be a safety valve. Sometimes it was secure, at times it was securitization, at times it was other forms of non-bank finance. The question is, where is that very gray line between safety valve and source of financial instability? And that's the part I struggle with, which is the use of indirect regulation is only pushes in one way on that dimension, which is to keep restricting and does not ask the question, are we discouraging in some way or encouraging growth of non-bank activity that could be a source of instability? So I fully agree.
Totally agree.
So I want to make sure we just have a few minutes left, but I want to make sure that we have an opportunity to get at least a few questions in from folks in the audience. If people have have questions of our panelists, anything that they'd like to hear about, or any specific questions. I'm not seeing any.
Sounds like you can keep asking.
Stunned silence. So I think we're just maybe 2 minutes out. And so, maybe just, in the interim, so look, I'll ask a question and maybe just get rapid fire here down the line. We talked a little bit about cost-benefit analysis and the importance of doing that. If you think about, and to return to a point that Andrew made, if you think about where we are in sort of the macroeconomic picture, which Andrew, I think, did a really great job of summarizing, and if you think about where we are in the context of the financial system, and I'm putting you on the spot, but such is the want of the moderator. If you could focus on one thing that you really think needs to be attended to, in the next year by regulators, could be the Fed, could be otherwise. What would be that one thing that you would want if you were advising regulators? What would you ask them to focus on? And I'll start with you, Andrew.
Oh, wow. Well, for long term, I think digital assets legislation is really helpful to get it, both from a market evolution standpoint, but also financial stability risks.
All right, that's great.
Yeah, digital assets are a key area, and there we need to think, particularly when it comes to decentralized finance, about the activity as opposed to the entity, and our legal system is just not set up to deal with that in an effective way, and that's just a big challenge that we all face. But it's not the only challenge that we face in thinking about regulation outside the banking perimeter. We need to think more broadly about that, because when you think about just Amazon, right? Amazon has 20 or 30 different kinds of payment connections that it connect to the rest of the financial system. That doesn't mean Amazon should be regulated like a payments platform, but those activities that Amazon engages in, maybe they should be.
So, to be boring, I will actually pick up on the very end of what Dick said. Not Amazon. I think the digital currency discussion, digital asset discussion, is actually too narrow. I mean, it's an issue, but a lot of the issues are well handled with existing regulation. It's the broader question about digital assets, and their interaction with payments. Some of which are distributed finance, others are just dislocation of payments from an evolution of the payment system. That to me is the biggest open regulatory question that we need to address right now.
Okay, great. Well, all three of you have done an excellent job of advertising, providing a bit of free advertising for our panel in the afternoon on digital, so that's great. But I've really learned a lot from this conversation. Truly appreciate your participation today. Please help me in thanking our panelists for their time today. It was great. Thank you.